We just started to consider how to start this session because last time when we have this MMA session, nobody heard us because we had some technical issues, especially on the StreamYard, the platform that we're using for our video conference and the live session. So just double check if you hear us and see us properly. Yeah.
Who's gonna check it?
Okay. Somebody.
MMA. Is that this topic? So these gladiators and strong guys fighting in the cage. This is the same.
Yeah, this we're talking about the gladiators, MMA, the Fight Club. Fight Club, but in more, let's say, today's and in a business casual way. Let's try to say it like that. Yeah, it's quite complicated.
Quite complicated. Okay. So Paweł Mączka,
Jan Sobieszczański.
I'm not the host, and
co-host,
and our guest, John Rotchford, right from sunny California.
Hey guys, good to see you.
Hi John.
Hi John, how are you?
Very good.
What time we have right now?
7:34 a.m.
So it's not bad. We have at 4:30.
Last time it was 5 or something like that. So
yeah, it's a little better.
It's getting better.
It is.
Okay, we have pretty interesting topic because you are the specialist here in this area. So M&A processes. But before, we want to ask you what have you done before? Because you were the DJ, right?
Yeah, back in the early days before we had CDs. So back when it was vinyl discs and tape, back in the 80s and early 90s, I was a club DJ doing mostly top 40 and house music was the two areas I focused in on back in Boston, Massachusetts.
So you actually started the storage cooperation in the early days. So you're using the tapes.
Exactly.
Yeah.
Tape and then optical. One of the first ones to have an optical CD that could actually write, and not just read.
Well, you know that after 30 years, the vinyls is selling more than in 80s. So I saw one of the articles that, it's selling more than in 84. So everybody would like to have right now the vinyls, and it's quite expensive.
I don't know, is it the consumer stupidity or just the good marketing, or this is the fashion? I don't know. Anyhow, today we are talking about M&A processes. And as a SASI and SASI group, you are delivering the services to your customers, selling one to each other in very simple words, of course. But it's much more complicated. So would you tell us a little bit about what is behind and what does it mean, M&A?
Yeah, sure. Maybe we can also talk a little bit about where the market's at and where we're seeing it in terms of valuations process in 2024 and 2025. But yeah, the concept of mergers and acquisitions, I think, is pretty straightforward. It's a marriage between two companies. It can take a number of different forms and structures. The most simple one would be company just comes in and pays cash for a company. But even that's not straightforward, because then they could often acquire the equity or assets of the company, so they could go ahead and buy the shares of the company. And that would be like a share purchase agreement where they come in and buy the company through acquiring the shares. They could also acquire the company by buying the assets of the company. So even within a quote unquote straightforward transaction, cash transaction with no debt, even then it can get quite complicated on how that deal gets structured. And then I would say the majority of the structures are driven by the tax treatment of the transaction and what's best and mutually beneficial for all concerned from a tax perspective and also from a risk assignment perspective. But the notion of mergers and acquisitions, a merger being just a different vehicle for putting companies together, or an acquisition is two companies getting married, combining forces with usually a strategy to have 1 + 1 = 3, where there's an inherent strategic value and synergies that are going to be realized through the transaction. That's the simplest way I can explain what mergers and acquisitions is.
So it wasn't so simple, but interesting comparison to the marriage. I guess marriage is not so structured. Yeah. It's more fun in there.
But you said, John, about this the trends. So you've been working in the storage industry for years. Could you share with us what's the state of the current M&A market and the trends that you see nowadays, but also what happened in the last years?
Yeah, I'll tell you. We just published our reports for 2024, and it was just a fantastic year. Best year in basically 7 or 8 years. We had over 11 billion in consideration in M&A deals in 2024. We had 4 transactions that were north of $1 billion, which is unprecedented in the 20 years that I've been covering it. From a venture funding perspective, there was north of $1 billion invested in storage and data protection, data management related technologies. So a very robust year coming off of the worst year in 2023 in over a decade, where we had less than 500 million in consideration, now over 11 billion in consideration in 2024. So quite a marked improvement in 2024, and they're really driven by 3 things. I'm sure you're going to ask me what's behind those numbers and why is M&A coming back. Really 3 things. One is we have a whole stable of venture-backed companies that are 7 to 10 years into their being born, and they're looking for exits. So there is a pent-up demand by venture capitalists in their portfolio companies looking for exit. That's number one. Number two, the strategics really came back to the table in 2024, starting to write checks and opening up their wallets, looking at M&A as an inorganic way to grow the top line, but equally important, a way to gain some technology and differentiation that they didn't have. Thirdly, private equity folks have really come back in to play, both at the lower end of the market. So private equity has a lot of dry powder. There's way too many private equity folks chasing M&A and too few deals. And they specifically target data management, data protection, storage as one of the areas that they'll be focusing in, not only in 2024, but in 2025. The new administration coming in the US with Trump, an ease of regulations, lower interest rates, a stock market that has been near at 52-week highs. You put all of that in a pot, gentlemen, and you stir it around, and you get a really active M&A market. So, and we don't see that slowing down in 2025, with the exception of a pullback, which we're already seeing in the US markets with technology companies, a pullback, not quite in correction territory yet. And but we don't think that's really going to affect M&A. It will maybe a little speed bump, but we see a very active M&A market in 2025.
Actually, I have 2 questions. One is out of the agenda, out of the box, let's say. So is it like the machine which could never stop because somebody started it previously, and they still need to buy and sell because otherwise everything will collapse? What do you think?
So what's the question? I didn't get the question. That sounded like a statement.
So we have the first question. Let's go to the next one.
Thank you. And the next one, this is the best comment. Yeah? And the second one, what got loud in 24 and 23? Was it?
I'm sorry, I didn't hear you, Jan.
Again?
Okay. Can you hear me?
Yeah.
Okay. So what got loud in 24 or 23? What was the deal of the year, let's say?
Yeah, I don't know if I'd call it sort of a deal a deal of the year, I'll say a couple of things on that. I think, number one, a lot of it was based around software. There wasn't a lot of systems deals. We were just talking about Lenovo buying Infinidat, just announced this morning. Infinidat is a systems hardware company. That is interesting because it's few and far between. What's been really driving the M&A market, not only in 2024, but in years past, is really software SaaS deals. So I think that's the message, and I don't think that's going to necessarily change in 2025. What I think we're going to continue to see is, you probably saw that Salesforce bought Own Backup for $1.9 billion. EQT, which is a private European private equity shop in Europe, bought Acronis. Vista Equity, another private equity shop, bought Nasuni for $1.2 billion. And you guys know that Cohesity picked up Veritas for $3 billion. Two of those four is interesting because they were private equity led, which is probably the biggest news. If you were to look back over the last decade, it was maybe 20% of the trades had private equity fingerprints on it. The majority of the deals weren't. They were led by strategics. And now you have two of the four largest deals in 2024 being paid by private equity folks, which is pretty interesting. And their PE had a reputation for being bottom feeders and paying low multiples. Well, for Nasuni, they paid 12x trailing 12 months revenue, which is above the median, which is usually between 7 to 10x for SaaS companies. So not only are private equity folks coming in and buying companies in data protection, data management, but they're not afraid to pay market multiples or above market multiples. And then with EQT buying Acronis, they paid roughly 5 to 6x, which again isn't that expensive, but for where Acronis was from a growth perspective, one could argue that that was actually a premium paid for Acronis. So I would say that's probably the largest thread that we're seeing that makes us bullish for 2025. Is we not only have the HPs, the IBMs, the Dells, the Amazons, the Microsofts, and Google's buying companies, but now we have a whole new group of acquirers with private equity coming in and paying at or above market multiples for companies.
Just playing with the wording, Salesforce, they purchased.
I'm a little bit scared of a dry joke again.
Well, this is the let's say the most key. Actually, the Salesforce, they have their own backup because they acquired their own backup.
Their own backup.
So it's quite how to say it, expensive deal, 1.9 billion for the backup, so they could purchase somebody else for the less, I guess.
Yeah,
in a subscription model or whatever. That was a dry one, I know. It could be better.
Okay.
John, when we're talking about the M&A, for whom you see, or from the past years, who is the best target for the M&A, and for somebody who is looking for the M&A, how to start the whole process, especially in the storage area?
Yeah, I mean, big question there. I think how to really start the M&A, kind of start with the end in mind. I think going into looking at selling your company is something that shouldn't be a reactionary affair where you're responding to an inbound interest in your company. I think the ones that I see that are successful, even from the outset of starting the company, they make sure they do everything they can to make sure that whether it's 3 years or 5 years or 10 years from the founding of the business, they have set themselves up on a course and have set the company up from procedures and governance and control systems that then allows them to sell their company at the appropriate time in the quickest, most efficient manner. And when I say that, what I'm really talking about is legal, financial, human resources, organization, software and systems that help run the company. The more that those systems and procedures are documented and the company is well run and has controls and has measuring of what their how they measure their company, and they're good at managing their business, that makes it infinitely easier for the acquirer to come in and buy the company. So I would say that, you know, and candidly, those are all good things to do, whether you're looking to potentially sell your company, go public with your company, all of these things, or even just run your business. I would argue that most of the things to prep a company for sale is simply good business process to go through to make sure you know your business and you have all of your documents in order. So those are just a few of the areas to sort of focus in on.
But what was the average you see, the, let's say, the exit strategies after 3, 5, 10 years? Or, you know, I just, you know, try to figure it out or advise to the other entrepreneurs who are thinking about this kind of the M&A processes, you know, how to start, or you said about to have a proper, build the proper policies before the M&A, let's say, will start. So what's the average time frame that you see?
Yeah, I mean, a lot of it is market dependent, and what I mean by that is probably one of the greatest mistakes I see companies do is they somehow believe they control on when they sell their company, and nothing could be farther from the truth. And what I mean by that is if there is, depending on where the market is and what markets you're playing in, there tend to be windows for M&A. Example, 2023. If you were to come to me in 2023 and say, I want to sell my company for 10x trailing revenue, I would have told you to don't waste your time, because the market wasn't there. Deals weren't getting done. People weren't writing checks. So the company, let's say they came to me and said, I'm 7 years into my business. I got 20 million in ARR. I think now is a great time to sell. Well, it wasn't. So, right, in other conditions, it might be. Same could be true for saying in this coming year, I think it's a great time for M&A. So I think there'll be some companies that maybe are a little earlier, that are only 2-3 years old, that may be acquired. So it's hard to pinpoint it in terms of whether it's 2, 3, 4, 5 years into the company on when they're going to be acquired. I think the number one advice I would give to any startup is create an ecosystem and market map of all the players in your industry, and be incredibly judicious on keeping track of what everyone's doing. And when they start acquiring, or when a certain area starts to roll up, you're going to want to take a really good look at participating in that market. So I think the number one thing to do is to make sure you understand your competitors, your market dynamics, what segments you play in, and be incredibly judicious. And I'm saying, like, every month sitting down with your board and seeing where the market is, so that you don't miss those windows of opportunity to potentially sell your company.
Okay, so any other key factors except the market situation you should focus on to be prepared for the acquisition?
Yeah, I mean, I think I just said it, in terms of just making sure you know the market and where it's at, and not force something that doesn't need to be forced. So I think that's really the key to it. And I think the other thing is, I would say you want to be on the beginning end of the consolidation in a sector. And what I mean by that is, if there is an area within data protection or backup, or there is acquisitions happening in it. Great example, Salesforce bought Own, right? There's 3 other companies in that space, 3, maybe 4, that do Salesforce data protection, disaster recovery. Okay, well, Salesforce just bought the biggest one. Who's going to buy the next 3? Right?
I will not answer this question.
Not me.
Well, that's what I'm getting at, right? So usually the first company that gets acquired has the highest market premium, and then every subsequent deal, the price tag goes down. It's like Tesla Cybertruck. If you were the first one to bought it, you paid 40% over the ask. Now Elon Musk is giving huge discounts for the Cybertruck. It's the same thing in M&A. You want to be the first truck bought off the lot. You don't want to be the 10th company bought off the lot.
May I still? This is the same question.
Still,
yeah. I mean, key factors like what is very trendy and popular now, like cloud services, annual recurring revenue or monthly recurring revenue, or any others like that. Do you have any suggestions what we should focus on as the IT provider, IT reseller, or vendor?
Oh, and like how much revenue to have?
I don't know.
Got it. I think I get what you're asking is, yeah. So
I mean what we should focus on, like delivering the monthly revenue. It should be the cloud offering what we are selling.
So which key areas are taken under the consideration when the potential bigger players is watching?
What they observe. Yeah, exactly.
No, get it. The easy answer is everything, right? You know, when you do M&A, rarely is it one factor. So even if they have, let's say a company, you know, Microsoft or Dell or IBM or Amazon, let's say, or like Salesforce wanted to buy OWN to have data protection, data management capabilities, right? I can guarantee you that they looked at all aspects of the business. So what I mean by that is they're going to look at the quality of earnings, quality of revenue. They're going to look at the management team. They're going to look at the profitability. They're going to look at the channels, the sales process, everything that they do. So really all aspects of the business is where they're going to focus. I mean, there's certain thresholds where, you know, the moment you get to 5-10 million in ARR, the universe of acquirers expands. And I think we talked about that before, where, you know, the larger, more scale you have, the more parties will be interested in acquiring a company, and hence more competition would then lead to potentially an increase in the valuation range. But the strategics are getting more and more savvy. I think 5 years ago, I would have said that if you two would have just developed some really good code and IP, and you had a continuous data protection or replication, or you did some indexing really well, there was a time where people would just buy team and technology, right? And I'm sure you guys have friends that fall into that category. Over the last 5 years, we see fewer and fewer acqui-hire or IP purchases for great technology and a product that, let's say, only has 5 customers. There was a time when if you had great software and you had a dozen customers, especially larger ones, that may have been enough to get a nice exit for your company, right? The VCs would say, go out and land 10 customers and you'll be bought for 100 million. We're not seeing that. We're not seeing those deals getting done anymore.
Actually, 5 years ago, we had one of the best CDPs in the world, but we just end of life this product. Yeah, you actually started from the CDP for the endpoints and for the mobile devices, John.
See, that's a great example of you missed the window.
Yeah, we missed the window because when we actually invested and put the CDP and the endpoints protection, everybody said we are going into the cloud. When we finalized the product, everybody said, okay, there is a ransomware on the endpoints. We need the data protection. But we said, no, we do not coming back to this.
We're still following the rabbit.
Yeah. But this is actually my one of the next questions, because you said be close to the market trends and watch the biggest, and who actually should be the watcher, because it's quite a significant effort to understand the next move from the biggest. I'm smiling because sometimes I see that even the biggest, they don't know how to move and where to move, and how we as a smaller companies or the other startups who thinking about the M&A, how they should watch, or in a short, who should be the watcher?
Carefully, I will answer carefully.
Carefully.
Yeah.
Who should be the watcher? Yeah.
Well, and a lot of it, right, as you guys know, you find out a lot of good information by, going to conferences and events and having people have a couple of cocktails, and then they'll tell you more than they probably should about
alcohol.
So
alcohol.
the old school
Exactly.
way. Old school way. Okay.
Yeah, you got to go old school way. You're not gonna find it about it over a Zoom.
Yeah, that's the problem. Pandemic problem. Okay, you finished? You have the answer?
I guess so. I need to go to the conference and drink a few beers.
Okay.
That's right.
To start watching, yeah, to
Okay.
understand the market.
Okay, so maybe from a different perspective, the 10 biggest pitfalls on an M&A transactions you observed.
The 10 what?
Pitfalls. The transactions with the biggest fails. Have you?
The 10 biggest mistakes
Yeah.
on like where they fail or things like that.
Mhm.
Like why deals fail. Okay.
Yeah.
Yeah. I think there's a myriad of reasons why deals fail. Some of them are not in control by the seller. So I think there's a bit of a disconnect there sometimes, where when we see transactions fail, it often has nothing to do with what the seller is or what they're doing. So they don't really have any control over it. I think a lot of it can fail on the human dynamic of it. I think more and more buyers are starting to realize that the human capital in a deal is just as important as the intellectual property assets. So I see a lot of deals fall apart because the buyers and sellers don't reconcile cultural differences and how they want to manage the business and treat employees. That's probably number one. Number two is risk around the business, where potentially threat of litigation if it's a highly litigious area, or haven't properly protected the IP. So a big one that I have seen destroy value and ruin deals is the private software company never got assignment of rights from anyone that touched the software code. And buyers want to make sure, if they're buying a company and they're buying software with X million lines of code, that anyone that touched the software code doesn't have a right to own that software code. So they've actually assigned it to the company and have an assignment of that. So all of the mundane things like NDAs, contracts, assignment of IP, contract and employee contracts can become incredibly beneficial to closing a deal. It can also derail acquisition, as can OEM agreements and any other material agreements that the company has. So I would just make sure that when any company signs a partnership agreement, that they read it very carefully, because oftentimes there are parts of that agreement that can make M&A very difficult, and for the buyer to say it's not something they necessarily want to take on.
Do we have the IP to our code?
We have an IP address, but not IP. Once I touch the code and the server stops, so I do not touch our software.
I remember.
Yeah, it's not simple. John, one of the next questions, because if somebody will be interested to get the M&A, how to go through one of the, I guess, toughest scenarios, so the negotiation part. Uh, and this is one of your roles as a SASI to help and cope the companies to go through all of the process. But could you share some hints and tricks here, or to give the best practices how to go through the process and properly negotiate?
Yeah, I think the biggest thing is to view it as a more of a collaboration than a negotiation. Is the way we tend to look at it. I also believe in seeking more information than necessarily dictating or coming up with having it need to be adversarial. I think there's a bit of a mystery out there on how to negotiate M&A, and I think one camp makes it a lot harder than it needs to be. So where you look, you go. So, you know, Pavel, if I'm negotiating with you, right, and I'm going to buy your house, right, and I go
The
into
old
the
one or the new one? So
exactly, and I go into that negotiation thinking it's going to be extremely difficult and it's going to take 6 months to negotiate. I guarantee you it's going to be difficult and it's going to take 6 months to negotiate. So I think a lot of M&A does not have to be hard. So I have been able and blessed to have negotiated many deals where we did it. There was maybe a few points that were contentious, but valuation wasn't one of them. In fact, I would argue that the easiest thing to negotiate is the actual purchase price. So the purchase price you get to really quickly. It's, hey, they make an offer, I get with my client, and we either agree or disagree. And it's pretty clear cut. And I would say the key to negotiation is always to realistically know that you may need to walk away from it. So I call it positive neutrality. Never get into a negotiation where you're attached to the outcome, period. You've already lost. So for you folks listening, that's the number one thing. Do not get attached to the outcome. It may not happen. And know the number you want and go get it. So now, having said that, let's say we agree the deal is going to be 50 million, all cash up front. 90% of the work is in the other 100 things we're going to have to negotiate within the definitive agreement. So everyone thinks purchase price and bankers add all of the value on purchase price. We don't. The purchase price becomes self-evident. There's market multiples. We know the buyer. If we've done a good job, we know what it's worth to them. They don't want to overpay and we don't want to undersell, correct? So we meet in the market on the valuation. That's not that hard, guys. The hardest part is everything else I was talking about. All the logistics of getting through a definitive merger agreement, definitive acquisition agreement. That's why you hire a banker. And to also create a competitive process where you get multiple term sheets in it. And that's what I would say is some of the keys to getting a deal done and what we do on the investment banking side.
Thanks, John.
Okay, but you know, company is not only for you as the owner, but a lot of people who are working for you. So what about those people? How you preparing the team for the acquisition?
Yeah, that's where, as I said earlier, I think culture and alignment of culture. I did a deal with a professional services company. They had 100 of the best engineers on the planet in ASIC development, chip design. And we purposely did not take 2 offers because of cultural differences where the founders and the management team didn't want to work with those guys. So I think a big thing is looking at not if valuations are the same, and in this situation they were, the company is going to pick the buyer that has the best cultural fit and best alignment on how they treat people, because they know that at the end of the day, the assets walk home at night. And if you don't take care of the people, you basically aren't acquiring anything. In 6 to 12 months, the company is going to be a shell, right? So how you do that as a seller is challenging, because there's a whole range of when do you tell employees that you're about to be sold, who do you bring in to the process, who do you not bring into the process. And that's something, as an investment banker, I think is something that has to be handled very delicately and on a case-by-case situation. So I've seen it done a couple of different ways, and I don't think there's one right answer on how to do that. It's really specific to the company and what they do. To give you an example, I had a client from the moment I was engaged. We had a town hall meeting, and he told all 70 employees about me and that the company had been approached, and he let everyone know that there's a potential the company will be sold in 6 months, and it's going to be a good thing. All the employees are going to stay on board. We are not going to do a deal unless the acquirer wants to grow us and wants to grow us even more. So this is good news. Quite shocking, right? You go tell all your employees, that's risk, right? People would say, don't do it, because all your employees are going to go leave. They're going to go work somewhere else. No, this guy had a trust relationship with his employees. He always was very transparent on the company. Everyone knew what everyone else made, by the way. No one in the company didn't know what the salaries were. How's that? It's a fantastic company. With over a 2-year period, he lost 1 employee. They were family. So would you tell your family that you're selling the company? Of course you would, right? He treated his employees like family. Now, other companies, they don't have that culture. They don't have that trust. And in those situations, I wouldn't tell all 75 employees, because there's no trust. There's no family, right? People are going to, go out the side door, especially if they don't have any equity. That's the other thing. He'd given equity to all those employees. So of course they're going to stay because they have equity, right? But if you have 100 employees with no equity and you tell them you're going to sell the company, what's in it for them, right? So it's a very complex thing to go through, Jan, in terms of thinking through it on how you deal with employees. And there's no right or wrong answer here. I'm not saying one's right, one's wrong, but it's something that, sellers really need to take consideration of early in the process.
Okay, but in most cases, people are saying that everything gonna be fine, but afterward it happened. It's not, and it's happening in number of cases. So how to prevent it?
Yeah, it's great. We've written it into the post-integration acquisition contracts. So in some cases, it is specified the reporting structure in that the acquired entity will remain an independent unit. So I've seen it where it's a binding part of the acquisition that they will not make anyone move. Like the big thing is you buy a company, let's say in San Diego or in Warsaw, and they say, hey, everyone gets to stay in Poland, right? And then 2 months after it, they say everyone's got to move to Germany, or everyone's got to move to London, or half of you are going to be transferred somewhere else, right? Well, all of that can be mitigated in the engagement letter or in the definitive agreements. So there's ways to backstop that. Also, making sure that whoever the GM of it remains the GM. As you guys know, the most disruptive thing you could do to any company is put a new manager in, right? So I've worked on agreements where for at least a year, there's no management change.
Okay, so I guess your suggestion is to onboard some legals who will help you with all these kind of agreements you need to sign, yeah?
Yep.
Sounds complicated.
And it is. John, what is actually the real hotspot today in 2025? How you see which type of the companies? We, of course, working in the data protection field, and we already said we've seen many acquisition related to the data protection, and we haven't seen it for a while, actually. Like few years was actually, I cannot say nothing, but
it all happened last year.
Yeah, but it's huge. Yeah, it started. in many areas. So is data protection is a hotspot? How you see it?
Well, anything around AI, and I think if you look at the whole AI, machine learning, that whole space is certainly hot. Training and inferencing, data cleansing. There's a lot of work being done in unstructured data management on how you amalgamate and take all of your data. Let's say from SaaS applications and CRM applications, structured and unstructured data. How do you amalgamate that all together into, let's say, a snowflake or a data lake? And then how do you then start your AI projects around that and mining that data and developing the algorithms for various business cases or projects that are getting used? So if anyone that's playing in that universe, both on-prem and in the cloud, there's a tremendous amount of investment in that. We have a client we're working with in that sector. And at this point, I'm seeing more investment than M&A because it's so new, that whole area. So I think that's an area of tremendous investment that will then move to M&A in the next 12 to 18 to 24 months. In terms of, what I see as hot, it's going to be, there's a bunch of companies, you guys, that just need to be acquired or go public. These are companies that have been on our market map for 7 to 10 years and are doing quite well. They have, 30 million, 40, 50 million in ARR. They're profitable, and they've just not been able to have a liquidity event. So I think the biggest thing that's going to drive M&A in 2025 is the fact that venture capitalists have a backlog of healthy or fairly healthy companies that want to see an exit and want to have the realization of their 7 or 10 years of hard work and have a liquidity event. And I think the market's right for that. So I think the VCs want to sell, and I think the acquirers are going to be active because of this new administration. And I know this is a US-centric world that I'm mentioning, but as you guys know, the vast majority of M&A is led by US buyers. So if I look over all the deals, right, it's 70, 80% that are being led by private equity or strategic buyers that are located in the US. And with the easing restrictions of something called CFIUS, which is reviewing every cross-border M&A transaction, that's going to be huge. And with Donald Trump, who's going to be a lot more open to larger mergers and not holding those up, bodes very well for M&A in 2025.
Like Greenland.
Yeah, he's going to go get Greenland and Panama. Maybe Poland. Why not, right?
Why not?
Okay, and is it always about full exit, or we can buy 30% or 50? I mean, minority or majority?
Yeah,
How does it work?
Yeah, I mean, definitely. There's opportunities to sell half of a company. We've worked on transactions usually with private equity institutional money where they end up buying half the company, and that way you have a business.
Can you find any trend or any path here? The trend is to buy 100%, or the trend is to buy the minority, because we can observe different trends. And
yeah, I mean,
yeah,
in acquisition, right? It's always 100% in almost all cases. So when we look at acquisition, it's going to be for 100% of the stock or the assets of the company. And then there's certainly in the investing world people that will take a minority investment in the business, and normally the companies do that because they want to keep control and they don't want to sell all the company now. If I think I have $100 million company eventually, but I'm only valued at 20 million today, I don't want to sell 100% of my company today if I think I'm going to be worth 100 million in 3 years, right? So smaller equity investments give a way for growth capital to help with working capital requirements to help you get to that 100 million valuation, right? So, and we see that's going to be very active too in terms of the venture world. And we don't see that slowing down in 2025 either.
Okay. 51 is control, right?
51 is control, but I could come back to my previous question because I asked about the data protection trends in the purchasing, and John said about the AI
He
stuff.
didn't answer.
Yeah,
AI is a bubble.
Yeah, so we need to add some AI, at least AI assistant into the store backup and recovery, I guess.
Yeah, avatar.
Yeah, so I mean, you guys know this because you live in, I should be asking you that, right? Because you guys are in the data protection market, right? The interesting one that we're seeing is a convergence with cybersecurity. Every data protection company is now a ransomware company, right? Everyone that cybersecurity wants to do that,
or trying to be, from the message perspective. I saw today sorry, John. I saw a good meme that how the product management works, and it was 2010, and it was, how is your product? We are cloud based. We are concentrating on the cloud. The same product in 2015, we're using the blockchain. 2025, we're using the AI, and nothing changed in the product. So
it's the same.
Like that. You know the drill.
Yeah, it's the same product, but just different marketing.
Yeah, exactly. Different message. But as you said, the right at this stage, the key message is to how you could leverage the AI and the security in the data protection platform. So we know we speak with the partners, DSTs and customers daily basis, and we see that especially the security trend, it's more and more important here.
Yeah, and just to add to that, I will say I think there is still way too many data protection software companies out there. So I think what I'm hearing, way too many. And the reason why I say that is I think there's going to be a reconciliation and consolidation really being driven by the enterprise customer. Look at any Fortune 50 or Fortune 100 customer, and you'd be amazed at how many different disparate data protection platforms they have. They have some for unstructured data for endpoints. They have others for semi-structured data. They have other for block. And then for all their SaaS applications, they're using another party, right? Well, if you're looking at really, and this is why the notion of bringing your data together for the use of artificial intelligence, it isn't a joke. I'm not making fun of that. It's a reality, guys. You can't build models unless you have the data. And if your data is sitting in 10 different repositories, you're fucked. All right. So this is happening now. You know what I mean? So
no, because you have one software which is addressing that issue.
Exactly. That's exactly right. So that's real. That's not coming from you guys. That's coming from end users, right? End users are tired of having 10 different vendors for their data protection DR schema, right? And they have a bunch of legacy, and a lot of it, as you guys know, it's dictated by legacy hardware that they have and legacy data centers that they have. So then they go to the cloud, and then they have a whole new architecture in the cloud, but that brings a whole new set of problems, because how am I protecting and managing all my data in the cloud? I got stuff on-prem, they have stuff everywhere. So what I'm hearing and what I'm being asked by the larger competitors that you have is, John, help me figure out how I can build a next generation data protection company that can serve a bigger set of problems within these enterprises.
So let me summarize a little bit. So I noticed that to prepare yourself or your company to the acquisition, you need to have the revenue, you need to have the profit, you need to have ARR, proper culture of people, vision, values, social conditions. So you need to be perfect company. True or false?
I wouldn't say perfect, but you want to be able to have good grades. You get your report card, Jan. If you have a report card on M&A, you don't want to have Fs in any of those, right? But you can have a C, a B, A. you're right. You're not going to get an A in every category, right?
So
You might have great revenue growth, right? So think of it like a report card and a GPA. You want to have a good GPA across all those things.
So lower price because you are lower with your, let's say, estimations. And could you recommend any good banker who can help in the process?
Bankers? Yeah, me.
That was the question.
No, honestly,
Okay.
no. About 30% of all deals don't have a banker involved. I have counseled certain clients not to have a banker. There's situations where you don't need a banker, right? You need a really good M&A attorney. So if it's like, for instance, if it's a buyer that offers a price that's double over market for your company, why would you go disrupt that, right, by shopping the company around and getting a banker and running an M&A process? I've also been engaged in those too, where I'm almost acting more like an M&A attorney or deal closer, more of a facilitator than I am a true banker trying to find the buyer, right? And sometimes we get engaged where I get a call and it's, John, we have a $50 million offer. It's twice over any other offer we got. We're bringing you in to close the deal and negotiate on our behalf. Okay, I can do that. I can do that. So could a good M&A attorney, a business-minded M&A attorney, not a legal-minded attorney, but a business M&A attorney who's going to help you close the deal, not destroy the deal, right? So I always caution people, just don't run out and hire an investment banker. Certain situations don't require it. But having good counsel and a good advisor is absolutely critical to getting a deal done. And so from that perspective, yes, we add value, but it's always making sure that what is that banker going to do? And sometimes you have board members that can help out as well. And so I think it's really a case-by-case basis, and just be clear on where you need help and where you don't need help, I guess is what I would say.
And in short words, because we're running out of time, what is your role? So how are you helping companies? I know you are the advisor, but what else?
Yeah, like I mentioned, I think the number one thing we bring is objectivity to an engagement where we're not tied to the outcome. I think the worst thing you can do is hire a banker or an advisor that somehow gets personally tied to a transaction or gets tied to the outcome. I think having an advisor that's aggressive and honest and willing to help you through that M&A process and think strategically about your business and isn't afraid to say, don't take that deal. I think one of the best values that I can bring to an event is to sometimes say, I know you like the offer, but I think in 6 months you're going to be worth twice as much, which is really helpful advice for the board and the investors. It's also very valuable sometimes when we get a superior offer and the client thinks it's too low. And then I have to walk them through that this deal's only going to come around once. And if you walk from this deal, it's likely never to come back. So you better be super clear that you think you're going to be $1 billion company, because you're walking away from a $100 million trade that's at 15x trailing revenue, which is at the top 10% of all trades over the last 5 years, right? That's valuable information to know. So I would say sometimes it's helping them understand the market from a neutral perspective and do the deal, or sometimes it's don't do the deal. You have untapped value in your company and go fight the good fight for another year and look to exit at 4x within 12 months.
The most funny part in your role and job is which stage of the process?
I think that the funniest part is probably on the human dynamics of different different cultures, different countries, and bringing them together. Where if it's a company in Texas that's buying a company in Canada, right? Texas is its own country in the United States. I don't know if you knew that, but it's its own country.
They shooting through the Zoom. They
so you have guys with a lot of guns and a lot of ammunition,
yeah.
Dealing with people that maybe have no guns and drive a Prius or some electric vehicle, right? So liberal, conservative, all that cultural stuff is fun in finding a middle ground to get a deal done, right? That's always very enjoyable, and often there's a lot of humor in that, because if we're not laughing about it, we're crying about it.
Okay, nice. So I'm good here.
Yeah, lesson learned.
Lesson learned. So never play with the Texas guys.
Go for the revenue and prepare your people. Fantastic, John. Maybe some questions to us to Polish markets.
Yeah, would love to hear what you guys are seeing. I know a little bit about your company and your product. What's driving you guys? What's getting you excited for 2025 from a product market perspective? And what do you guys see? Because you're really dealing with the customers, right? What are they asking you for versus what you saw in the last couple of years? And what are you excited about in 2025?
Who's gonna be the first?
At my age, it's skiing, biking, swimming, and things like that. So you need to answer.
From my perspective, of course, is a continuity of the Broadcom acquisition, so 2023. So we still see the
tsunami
effect that many of the organization will move away and invest into the other hypervisors and virtualization engines, which is, let's say, perfect news for us, because we always from the beginning were focusing on the KVM base and Zen base. So it's quite a great space where we are, and we're looking forward to grow in this area and be one of the top choices for any customers or the partners who will look for the enterprise-grade data protection platform.
We have so many requests, and the roadmap is so long that it will take another 5 or 10 years to deliver everything. Anyhow, I think we are excited about new approach on the US market and North American market, new distribution with Ingram and cooperation with Verge, which is who is also the answer for the Broadcom and VMware. And what else? We're investing in channels, so this is something what is always exciting because of different countries, different cultures.
Same as you said with the Texas guys, but we see in the different regions that we trying to speak with the same language, but we are very so much because of not only the time zone differences, but the culture itself and the
different priorities.
Let's say.
Well, I did my own research on you guys, and unlike some of your competitors, the feedback was extremely positive. That what you say you have, you actually deliver, which isn't necessarily true of all of the California venture-backed companies that I see that are a lot of hype and a lot of vaporware.
Not true. This is not true. He is promising, I'm delivering.
Well, whatever you're doing, it's working, because I spoke to some people that knew you guys and know your product, and they gave it high marks across the board. That all the stuff that he says you can do, you're actually doing. So whoever's promising it and delivering it, it's working from what I hear. So congratulations on that.
So that's why we need to work, both of us, and drive the same vehicle all the time.
Yeah. Thank you very much, John. Well, thank you for the good words, and thank you for a good conversation.
Yeah, absolutely.
I hope you will come to Poland.
Absolutely. I got to get to that part of the world. Yeah, you
Yeah,
may see me in February.
Okay.
That's all.
Anything from you?
I'm good. I'm good. So looking forward for the 2025 for like today information infinite that with the Lenovo, which is actually huge. So I'm looking forward for the next M&A in this field because it's getting more and more interest. And what John said, the market will consolidate because not only the Forbes or Fortune 500, they don't want to see dozens of the different applications in a data protection space. So let's see how it goes.
Yeah. Thank you very much.
And let's see, maybe we do this again in a year, and we'll see if any of my predictions came true or whether I was completely wrong.
Good idea.
You bet. Okay. Have a great day for all of the watchers. So if you have any questions, you can post it below the live, or if you watching as a post production on a YouTube, no worries to just leave a comment. We'll answer you in ASAP mode. So
Thank you
John,
to our guest, John Rotchford, banker and DJ.
Hey, thanks, guys.
Thank you.
See
Bye.
you. Bye-bye.
Bye.